Hey everyone, and welcome to this Ultimate Exam Explainer. Our mission today is pretty straightforward, but absolutely critical. We're going to master the core concepts of corporate finance so you can walk into that exam room with total confidence. Look, at its very core, corporate finance really just asks three fundamental questions. What should the firm invest in? How are we going to finance those investments? And how do we manage the day-to-day cash? But underneath all of that, the whole shebang, there is one ultimate objective governing every single move: maximizing firm value. Because a higher firm value benefits the shareholders and builds a financially robust company. So we're taking a super energetic, highly analytical approach today. We're cutting straight through the noise to focus exactly on the real-world mechanisms you need to understand. Let's get into it.
Okay, let's dive right into this. Here is your strategic blueprint for today. We're going to cover frictions, that's asymmetry and agency. Then, decoding capital structure. Next up, payouts and M&A. After that, governance dynamics. And finally, we'll wrap it all up with an exam survival framework.
All right, Section 1, frictions, asymmetry, and agency. Essentially, the invisible forces that are destroying firm value.
So in a perfect textbook world, maximizing firm value would be easy, right? But out here in the real world, we've got two main villains that complicate literally everything and create friction: agency conflicts and information asymmetry. Let's tackle the first villain. An agency conflict happens when different groups, both inside and outside the firm, have completely competing interests. The core mechanism to understand here is the friction between what the owners, the shareholders, want and what the managers might actually do in practice. Shareholders obviously want managers to maximize firm value, but managers, well, they're human. They might care way more about their own salary, their job security, or, just seeking private perks. It's the classic battle of maximizing the firm's wealth versus the manager just building their own personal empire. Think of a real-world scenario. A CEO decides to buy a massive, ultra-luxurious corporate jet just for the prestige, instead of paying that cash out as dividends to the shareholders. Boom, that is an agency conflict in action.
Now those agency conflicts, they are deeply connected to our second villain, information asymmetry. This is simply when one party knows more than the other party. Now listen up, because I want you to memorize this absolute golden rule for your exam. Adverse selection is before the deal, moral hazard is after. To make this stick, think of it like this. Adverse selection is like buying a used car where only the seller knows the engine is about to fall out. Moral hazard, on the other hand, is someone driving completely recklessly simply because they just bought premium car insurance. Bringing it back to the corporate world, adverse selection is about hidden information before a contract is signed. So if a firm suddenly issues equity, outside investors are going to think, wait a second, do the inside managers know the firm is overvalued? Moral hazard, on the other hand, is about hidden action after the deal. Once shareholders get debt financing, they might suddenly want the firm to take on excessively risky projects. Why? Because they get the massive upside if it works, while the creditors are left holding the bag if it fails. Just remember, hidden information before, hidden action after.
Understanding those frictions is super crucial because they directly influence one of the biggest, most important questions in corporate finance. Pivoting to the right side of the balance sheet, we actually have to ask, how much debt should a firm really use?
Which brings us to Section 2, decoding capital structure, the strategic battle of debt versus equity.
Now, what's really interesting about this slide is the strategic evolution of capital structure theories. The starting point here is the famous Modigliani and Miller theorem. Under perfect market assumptions, they prove the capital structure actually doesn't affect firm value at all. The size of the pie just doesn't change no matter how you slice it into debt and equity. But, and it's a big but, we don't live in a perfect world. When we add real-world elements like taxes, debt suddenly becomes incredibly valuable because interest payments are tax-deductible. It creates this beautiful tax shield. So trade-off theory steps in and tells us, hey, balance that tax shield against the ugly real-world costs of financial distress and bankruptcy. Then we have the pecking order, which throws taxes out the window and focuses purely on avoiding our old friend information asymmetry. And finally, market timing suggests managers are just strategically issuing securities based on temporary market mispricing.
Let's actually zoom in on the pecking order for a second because it perfectly illustrates information asymmetry in action. The theory says a firm is going to use its internal retained earnings first, then it'll turn to debt, and it will only issue equity as an absolute last resort. Why? Because issuing equity sends a deeply negative signal to the market. Remember, insiders always know more than outside investors. If managers are choosing to sell shares, the market immediately assumes, those managers must think the stock is currently overvalued.
All right, moving right along to Section 3, Payouts, M&A, and Value. Basically, where does the cash actually go?
So once a firm has navigated its capital structure and, actually generated some cash, the management faces a massive strategic choice. Should they keep it inside the firm for positive NPV projects? Should they return it to the shareholders? Or should they go out and just buy another company? If they do decide to return it to shareholders, they generally have to choose between dividends and share repurchases. And here is your next vital exam rule. Dividends are commitment, repurchases are flexibility. Dividends are incredibly sticky. Paying them signals that managers are super confident in stable, future cash flows. But, and this is key, a dividend cut sends a dangerous, flashing red negative signal of financial weakness, which is exactly why firms hate cutting them. Repurchases, on the other hand, are highly flexible. Think about massive tech companies choosing repurchases over dividends so they don't lock themselves into rigid expectations during volatile years. A firm can buy back shares when it has temporary excess cash, or when it wants to offset dilution, all without sending a massive negative signal if they just stop doing it the very next year.
But what if the firm decides to use that cash to buy another company? Mergers and acquisitions can absolutely create value through synergies, right? Making the combined firm worth more than the two separate parts by cutting costs or gaining market power. However, it can also violently destroy value. And this connects right back to our first villain, agency problems. As this quote hits the nail on the head, managers might overpay for a target simply for empire building. They just want to manage a larger firm so they get more power, more status, and a bigger paycheck, even if it totally ruins shareholder wealth.
Section 4. Governance and Ownership Dynamics, Controlling the Conflict.
Okay, so if managers are constantly tempted to build empires and destroy value, how do we actually rein in these massive agency conflicts? Well, this is where corporate governance, board composition, and ownership structures step in to monitor management and align everyone's incentives. But before we even analyze governance, I need to give you a really quick, rigorous caveat regarding corporate finance research. Seriously, this is an instant way to secure A-grade points on your exam. When you're discussing the impact of, say, board independence or diversity on firm performance, you absolutely must warn the examiner about endogeneity. Just because two variables are moving together does not mean one causes the other. For example, if the data shows firms with more independent boards perform better, you cannot automatically conclude that the board independence actually caused that better performance. Actually, it's entirely possible that successful, highly profitable firms just naturally attract better, more independent boards. Always highlight this analytical insight.
And this brilliantly illustrates the whole complexity of ownership structure, particularly when we look at family firms. Think of those legacy family businesses in retail or the auto industry. Family ownership is a classic double-edged sword. Over on the left, we've got the advantages. They have this amazing long-term orientation across generations, deep trust, and immense resilience. They basically solve the traditional owner-manager agency conflict because, well, the owners are the managers. But look at the right side. They create entirely new disadvantages, nepotism, and a totally new agency conflict where the controlling family might decide to just milk the business to extract private benefits completely at the expense of the minority shareholders.
We made it! Section 5, the exam survival framework, tying it all together for maximum points.
As you've probably noticed by now, corporate finance is literally almost never black and white. Debt can create awesome tax shields, but it also brings terrifying bankruptcy costs. Dividends signal incredible strength, but they limit your future investment capital. Because the exact same decision can create value in one situation and completely destroy it in another, you need a highly actionable blueprint for structuring your exam essays. Here's the 4-step sequence you should be applying to every single essay question. Step 1. Define the concept clearly. Step 2, and listen, this is the most important one. Explain the economic mechanism. Do not just spit out memorized textbook definitions. Focus intensely on explaining the how and the why. Step 3, discuss both the advantages and disadvantages to show the examiner you truly understand the trade-offs. And finally, Step 4, provide a smart, balanced conclusion based on the specific scenario you were given.
So the crucial point here is this. The absolute best way to think about corporate finance is realizing that every single decision in your entire syllabus ultimately affects firm value through these 5 overarching drivers: cash flows, risk, information, incentives, and control. If you can clearly, logically explain how a financial decision changes those 5 things, you are going to write a phenomenally strong exam answer.
I want to leave you with this final provocative thought to carry right into your study sessions. Apply this analytical lens to literally every question on your exam. If a financial decision doesn't positively impact cash flows, risk, information, incentives, or control, why even make it at all? Keep your focus locked on these value drivers, remember those real-world mechanisms, and you are going to do incredibly well. Thank you so much for joining me for this explainer, and best of luck on your exam. You've got this.